Hi there, Ashley Buchan, mortgage loan originator, and I have a topic to discuss today regarding supplemental tax bills. And it's a very important topic for any homeowner during the first or second year of home ownership. And what happens is when you set up an impound account through your loan to pay your property taxes and your homeowner's insurance bill through the monthly mortgage payment, then the lender collects money from the borrower monthly in order to go ahead and pay that tax and insurance bill when it becomes due. So the lender will go to the tax assessor website and they will pull a copy of that tax bill. Unfortunately, what happens is the tax assessor doesn't update the tax records right away after you purchase the home. So when you close escrow, you fill out the price you paid of the home on a form called a preliminary change of ownership, and you submit that form to the assessor. Well, the escrow company does that for you. And then what happens is they reassess the value eventually based on what the price you paid is and what they feel the home is worth. And then when you pay your taxes monthly, the lender will go ahead and pull a copy of that bill from the assessor's office and they will pay that bill. Unfortunately, if it's not updated and it's based on the previous owner's amount of taxes, then that could be too little money that they're going to collect because it hasn't been reassessed for the correct amount. So then the lender would have too much of your money and they have no choice but to send you a check for the difference. And that's because there's a law that says we can't have more than 2 months of reserves for the taxes and insurance in the impound account. So when they send you that check in the mail, that needs to be set aside to pay the taxes when you get the supplemental tax bill, because that money is going to be billed to you directly since it hasn't been updated yet. So unfortunately, it can take a year or two for the assessor to update the fact that you've bought the property and what price you paid. And at that time, they send you a bill, and sometimes the borrowers don't have the money to pay it because they didn't know that they were supposed to save that money. So it's a really, really important topic, and definitely don't want to see homeowners get hit with a huge tax bill that they weren't prepared for. So what I always advise my clients is to contact me anytime the lender drops the mortgage payment, because anytime they send you a check in the mail for the excess funds in the impound account, they are going to drop the mortgage payment because they don't want to collect too much money from you. So therefore, when they drop it, once the tax assessor reassesses the property and increases it to the price you paid compared to the previous owner, what's going to happen is you're going to be short funds in your impound account for the future taxes. So it's really important as a homeowner to send a copy of that supplemental tax bill to the lender and say, here's my supplemental tax bill. I need you to increase my mortgage payment back to what it was because I don't want to have a future shortage. So these are key things to do and to know about, because oftentimes I've heard that homeowners will take that money that they get the check from the excess funds in the impound account and spend it and not know that they need to pay taxes with that money, which is a big nightmare. And then they don't have the money to pay the taxes. And second of all, they don't know that they need to get the taxes, the monthly payment increased to cover those future taxes to be the correct amount again. So unfortunately, this is something that all homeowners have to deal with during the first or second year of home ownership when the property is reassessed. And basically, it's the difference between the price or the assessed value when the previous owner owns the property and then the new purchase price. So it can be the exact opposite effect when you buy a property for a lesser price than the previous owner paid. It just all depends on how much the taxes are being collected currently and then what your price is that you're paying and if that's more or less. If it's more, then you're going to get a bill, and if it's less, you're going to get a credit, and if it's more, you're going to get a bill. But for more questions on this, please don't hesitate to reach out to me. I'd be happy to answer any questions you have, and thanks for watching. Hi, my name is Ashley Buchan, and I'm a loan officer, and I wanted to share some of my knowledge with you about doing home loans and helping people to buy. And the topic I wanted to discuss today is regarding income. And I wanted to share some little tidbits that I thought would be helpful to any potential home buyers or just any consumers out there that just want to know more about financing and how it works. One thing I wanted to share is that when calculating income for a W-2 wage earner, we would use the gross income before taxes are taken out rather than using net income. And why is that important is because really you're not taking home gross income, you're taking home what's left after taxes are taken out. So even though you might qualify for a certain amount, that doesn't necessarily mean you're comfortable with that. So my recommendation would be to make sure that you talk to your loan officer and tell them what monthly payment you would be comfortable with. Because just because you're approved for a specific amount doesn't necessarily mean that you should go that high. It's all going to depend on you as an individual, because some people might be having kids in the next few years and they might have increased expenses, or they like to travel and go on vacations and they may want to have some extra spending cash and they may not want their payment to be that high. So everybody's going to be different. Or maybe you know that you're needing to buy a car in the next 2 years and you're going to have a payment for the car and you don't want to have a high payment regardless because you know you have another expense that's going to be coming up into the future. So things like that. So that's definitely something to have a chat with about with your loan officer. Another thing about income I wanted to share is that when you're self-employed, we do go off the net income, not the gross. So how it works is we take a 2-year average based on your last 2 years of tax returns. So when you're buying a house, it's really important to get with a loan officer as soon as possible and to find out approximately how much you would qualify for based on what you're going to be claiming or what you're currently claiming. A lot of times as a tax preparer, the tax preparer is looking to try to make it so that you don't pay a lot of taxes. And unfortunately, that's the exact opposite of what you want when you're trying to purchase a house, because when you claim less income, you pay less taxes, and when you claim less income, you don't qualify for as much. So that affects your loan qualifications and your home purchase. So in the years in which you're looking to try to buy, you might consider writing off less expenses if possible. So for example, if you're having a large expense that you need to incur, maybe you wait until the next year to incur that expense so that on the year in which you're in, you have a higher income because you don't have to report that large expense. For example, if you have a big, truck that you travel things with, you transport things with, maybe you have to replace the transmission on the truck, and that's going to be $10,000 or whatever. I don't know. That expense could be prolonged, for example. So I don't know how your business works if you're self-employed, but those are some suggestions. And then the other thing I wanted to share is the 2106 expenses. So a 2106 expenses, if you're a wage earner, is an expense in which you don't get reimbursed for. So if you claim any 2106 expenses on your tax return, we would have to deduct those from your income. So that could also affect what you would qualify for. So those are 3 important considerations. And the other thing I wanted to mention is, let's say your type of income changes. For example, let's say you go from an hourly employee to a commission-based employee, or you go from a W-2 employee to self-employed. Anytime the way that your income changes that you earn, we need some stability there with that new source of income. So for example, if you have if you're earning bonus income, then we want to see a 2-year history of bonus income so we can take an average. If you're earning commission income, we want to see a 2-year history on the commission income. And if you transfer from a W-2 wage earner to self-employed or 1099 independent contractor, you're going to need a 2-year history with that income. There are exceptions that if let's say you're a CPA and you're preparing taxes for a tax firm, and then you go on your own and you start your own business and you start doing taxes for clients. Because of your previous experience in the industry, you could potentially get away with only 1 year of returns filed as an independent contractor or self-employed individual. But just know that could be an impact to your financial status. If you change jobs Usually they like to see at least 6 months in the new job unless you're in the exact same line of work. If you're in the same line of work and you don't have more than a 1 month gap in employment, then that typically doesn't impact your qualifications and you can get a loan right away, especially when your income's increasing. So let's say you leave a job and you find a better job. So your current job's only paying $20 an hour and your new job's paying you $25 an hour. Obviously, it's going to advance your career to take that new job. So it's in your best interest to do so. And that would not be a negative impact to you on your loan. If you have any more questions for me about income, I'd be more than happy to chat with you. And thank you so much for watching.